In this session, we will have a basic primer into the understanding of hedge funds, how we differentiate the hedge funds from the typical mutual funds, and what are the various strategies associated with the hedge fund managers, and on what lines you look at the risk associated with the hedge funds. A very brief introduction to this space. As we all understand, compared to the traditional mutual funds or any other securities, the hedge funds are less regulated, right? Whereas the mutual funds have the regulators in place, there is a lot of reporting requirements associated with the mutual funds. Whereas in case of hedge funds, because of the less regulatory thing, the transparency is pretty limited in a hedge fund. So they lack transparency. Even the investment strategies which they are getting into, they become more and more proprietary. And generally, these are not for the regular public, because the number of members in a typical hedge fund cannot cross, let's say, 500. So, and that too, the hedge funds play very heavily on the arbitrage profits. The most common trading strategy for them being the long short base. So they take long positions and short positions and try to exploit the mispricings in the securities and try to get the arbitrage profit out of them. So to achieve those kind of strategies, they get into very highly levered kind of positions. They use all these mechanisms, especially let's say when we talk about mutual funds, they are restricted from getting into short selling processes, they are restricted from using derivatives. So there are a lot of restrictions as far as the mutual fund investments are concerned, whereas with respect to hedge funds, we don't see any of those restrictions. And the performance based fee is very high, 20%, let's say, of whatever the returns that are generated above a set watermark. Any return above a watermark, these hedge fund managers, they have a very huge share of the profits. So that's a very differential kind of pricing or compensation structure for the hedge funds, which keep them completely above or completely unique from a traditional mutual fund kind of investment. And so because of lack of transparency, the strategies have become quite proprietary, and even the investors did not know whether they are traveling in the in a better direction or in a different direction altogether. So and probably sometime towards the late 1990, after 1998, where LTCM has seen a major financial debacle, what we have observed is hedge fund databases came into picture. And with respect to this hedge fund databases, they are more like a commercial database to which various hedge fund managers report the performance of their funds, and they are maintained centralized so as to help the investors, because of late we have seen a lot of institutional investors also coming forward to invest in this hedge fund. So that has actually opened the gates for an improvement in the transparency layer, which has resulted in some amount of hedge fund databases trying to capture the various performance of the funds over different periods. But of course, still they need to be reported by the fund manager himself. So if the fund manager chooses not to report, then the commercial databases don't have the information. That is what I am calling as selection bias. Because as far as the informing or reporting the information or the performance of the hedge fund, it is the responsibility of the hedge fund manager, or it is the option of the hedge fund manager whether he would like to report the performance or not. So if he opts out of that reporting, whatever the report which the commercial database is providing, it would be a biased report, because under the assumption that a particular hedge fund manager did not report the performance because his fund was performing poorly. If that assumption was true, then probably whatever the return that the index is showcasing, it is more and more of overstated kind of a value. But in reality, out in a research that was conducted, where a fund of funds managers reported return, because what is a fund of funds? This fund of fund manager invests in the various hedge funds, not just the ones which are reported to commercial databases. He can invest in those funds. He can invest in those funds for which the reports are all not there also. So his portfolio is purely a diversified portfolio of various hedge funds. Now what we are saying is the return which this fund of funds were reporting and what that common database was reporting, both of them were more or less similar, which means even if a couple of managers have not reported, means have led the system to a selection bias, still the impact was not that drastic. But along with that, the hedge fund can even get exposed to survivorship bias. The funds that were closed earlier, as long as the fund was active, it was considered as a part of the index returns and all that. But once the fund was closed, its values are not considered as a part of the return. So the increase, probably once that was moved out, it has resulted in an increase in the overall return. But the attribution is, it's not the fund industry has performed well, but the fund which was not performing well was removed from the index because it got closed down. So that is where earlier the fund that was included into the return or index computation, but now it not getting included because of being closed, is changing the overall return. That kind of mechanism is called as survivorship bias, because the whatever the funds which are not performing well generally get closed. So when I am removing them from the index, there is a possibility that the index or even the return will become overstated. So there should be a very clear cut understanding of the components and the composition of the index, the frequency of updating the index, the rebalancing kind of a mechanism for the index before trusting it out for the investment purposes. So just as a quick lookout, before 1996, the hedge fund industry was very drastically outperforming the S&P index. But with the fall of LTCM in 1998, the hedge fund industry got very badly affected. But again, from 2001 onwards, where the dot-com bubble has occurred, where there were so many short positions, there was a net inflow for the hedge fund industry. So again, it resulted in an outperformance of the hedge fund industry. It has outperformed the S&P index quite drastically with very little standard deviation, almost half of the standard deviation of the S&P index. So with that, again, huge demand for the hedge funds started, and even went to a situation where the institutional investors came very heavily into this industry. So it has grown many folds year over year over a 5-6 year period. But of course, during the last few years, because of the entire global financial crisis, even the hedge fund industry is having its own its own layer of disadvantages. So just looking at with respect to the equity market, any studies that were performed till date, all the studies that were performed till date, they gave one particular conclusion in common, that the hedge funds are not correlated with stocks and bonds. Very little exposure, very little correlation to the equity market, but they had a decent amount of exposure to the emerging market, but not to any other asset classes. That way, they were able to generate a positive alpha, but still without any exposure to equity market. That made people look at hedge funds as a different asset class altogether. So, and also one more research point that has come out is, compared to the index, compared to hedge fund index, investing in the large hedge funds, high sized one or few hedge funds, this has provided a much better return rather than investing in the index altogether. So alpha wise, initially there was a huge difference, but over a period, because of the increase in the competition for various hedge funds, even the alpha became decreasing over time. But the only thing is, it has nothing much to do with the equity market. So when I look at exposure with respect to equity market, it was not that much higher, but because of competition existing in the hedge fund industry itself, the alphas started coming down. And coming to the various risk factors, see, generally hedge fund strategies were completely different. A long short strategy, we have seen so many strategies, either a market neutral kind of a strategy, or the fixed income arbitrage strategy, where the investment was targeted toward the fixed income market, or probably a convertible bond arbitrage strategy. All these kind of strategies which we see, they are all quite different in nature, or event driven kind of strategies like merger market driven strategy. All these strategies, they have their own unique characteristics. So if someone has tried out or invested in these various strategies, it should result in a proper diversification. Normally what we have heard is, hedge funds try to specialize in one of the strategies, but in some cases they go for a mix, but in majority of the cases they try to specialize in one of the strategies and try to invest more of their positions in those kind of strategies. So when a common investor, he tried to diversify himself, he can diversify by investing different portions in different hedge fund strategies, or probably he could invest in fund of funds, which would again in turn invest in various hedge funds following different strategies for a purpose of diversification. But what is observed is, especially when the markets are very bad, the overall financial markets have collapsed, or economic situation in the country became worse, what we see is the diversification effect across all these strategies will actually go off, which means until that time the correlations between these various strategies were much lower, but because of those kind of extreme events, when the market is under extreme stress, we find that the correlations between them improved drastically, means all of them will really lose out, especially when there was a collapse of LTCM in 1998, when there was unexpected change in the interest rate policy by the Fed in 1994. They are all having serious, all of them have lost very badly. The reason being, One, the hedge funds use heavy leverage. And this in turn, when there is a huge market crisis, it creates severe liquidity problem. Means raising capital will become an issue. There will be a capital unavailability in the entire system. So, because the capital itself is not available, it's not a question about spreading the risk from this form to this form to this. The underlying base, the base capital itself is not available. So, there is no question of spreading the risk. So, it results in a severe credit issue or a liquidity issue. The whole portfolio will get into a severe credit related issue or funding liquidity kind of a risk, and that is what will cause the whole set of so-called diversified portfolios to become undiversified and collapse in one single shot. So what is being suggested is the fund managers have to critically try to evaluate these kind of extreme scenarios where the portfolios will be subjected to risk in such a way that the diversification effects will go up, and try to be alerted in advance itself so that the heavy losses can be avoided subsequently. And one more major thing that we see in this hedge fund industry is the risk sharing asymmetry because of the compensation structure. There is a, see here also we have principal versus agents. In the hedge fund industry, when I talk about principals, they are all limited partners who are investors. Whereas the agent is the fund manager who is acting with the principal's money. Now, because the compensation structure for this agent is very high, 20% let's say of the profits. When we say here the profits, the amounts that are generated above the watermark. So 20% of that goes as a profit. So to generate a very high profit, the hedge fund manager generally gets into a high risk taking strategy, which in case of a success, the fund manager makes money and even the investors also make huge money. But if the strategy or the bet is typically going bad, the fund manager will lose the investors will lose very badly, but the fund manager may not lose to that extent. And the whole losses will get piled up in the future. But of course, from a fund manager standpoint, he can think of closing that fund and starting up a new fund. But in that process, there is a possibility of his reputation getting damaged, so he may not try to look at it. So, from an investor standpoint, if at all the principal agent problem has to be removed or risk sharing asymmetry has to be removed, the investors try to prefer investing in that particular fund where the stake of the fund manager is much higher, because he is putting his own money. Whatever the risk he is taking, he knows that his money is also at risk. So the other investors, sometimes it's looked at like, okay, if the fund manager is investing 40%, at least 40% of the total fund, the remaining 60% comes very easily from the investors. But if the contribution is only 20% or 10% or even lesser, probably the investors show a very negative inclination towards it, because the fund manager is playing only with 10% of his money. So the trust that the investors will develop in the fund manager will go much lesser. So the higher the stake of the fund manager in the hedge fund, the more is the trust and the reliability of that particular fund. More and more investments can start flowing into that particular fund. So that is one major way where the asymmetry can be tried to address. And as I talked about earlier, there was a huge impact of institutional investors in the fund management industry, in the hedge fund industry post 2000 era. So, because of which there was an increasing demand for operational integrity and governance. And one thing we need to understand is with respect to the hedge funds, there is no consistent way of saying my alpha is better than the competitors, because there is no straightforward mechanism of finding out the alpha and associating alpha to a higher performance. So the hedge fund managers should really create a kind of a campaign for themselves, which will try to differentiate that fund from the typical funds of the peers. So, identifying and creating such a kind of mechanism to differentiate the funds becomes the need of in case of hedge funds. So these are some of the basic things we can talk about as far as the understanding of the hedge funds is concerned. If you have any further queries regarding the same, you can get in touch with me by giving me a call on the number I have given below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.